Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And today we're going to be talking about the eToro portfolio. If you're not already aware, I run an eToro portfolio and I'm a popular investor on the platform. You can check out a link in the description to either copy the fund or add to a watch list to keep an eye on what's happening. Today we're going to be talking about a first ever bank stock on this particular channel. I'm not usually a fan of banks, but this is a very peculiar situation. And so I want to talk today about my thoughts on ING, the Dutch bank, and what I think its prospects are for the future and why I think that the market has thrown the baby out with the bathwater in the sense that they are overreacting to some negative sentiment on the stock. And we'll talk about what I think it can be worth moving forwards. If you haven't already liked and subscribed to the channel, I would greatly appreciate you doing so. And without further ado, let's get into it. So this is the Crassus investment formula that I like to use for the core positions in the portfolio. We do have a speculation formula for special circumstances, including turnarounds. Today, we're talking about a bank. So low debt obviously is not going to be applicable there, but we're still looking for a margin of safety in terms of our valuation and the valuation metrics and methodologies that I use. I'm looking for sales growth, strong margins, free cash flow growth, and ideally share buybacks. If we can get those, we tend to want to pay close attention to the price and see if we can buy it at a discount. Here are some quick facts, okay? So ING, it's a European bank listed on the Dutch exchange. And so although you may see some dollar signs here, please don't be confused. Everything I've done has been in euros. It's just a template that I tend to use, reverts back to the dollar sign. So revenues and net income, okay, EBITDA is not applicable to a bank. Those are the numbers we're expecting to come in at the end of 2022. The current market cap, that's important. So 32.9 billion. Enterprise value not applicable, of course, as a bank. Price as at closing was €8.72. Okay, 3.77 billion shares on issue. And if you look at the history of the company, they've bought back 1.6 billion worth of stock over the last 12 months. And in addition to that, paid out 2.3 billion in dividends. So shareholder friendly. Return on equity, 9%. Not bad for a big incumbent European bank. However, let's take a look at the price action over the, particularly the last few weeks. As you can see here, pretty boring business. It trades in a more or less a range around its book value and dividend yields. Here you'll see the share price has absolutely fallen off a cliff. Okay, it's got whacked from just over 16. This will be converted to USD in trading view, but 16 US dollars all the way down to just above 9. Okay, so that's obviously a massive hit. Why is that? The majority of the negative sentiment is to do with the conflict that's occurring in Eastern Europe, as we all know. And it's feared that the bank has exposure in their loan book to Ukraine and Russia. Now, from what I can see, that is not really the case. And so I think that this is an opportunity when we can scoop in, or I will be scooping in here off this cliff dive and talk about why I think some of those sentiments are not fundamentally supported. Let's talk about the key points, okay? This will be a very quick presentation because it's a pretty straight up and down business, which is what I like. It's one of the better run Euro banks. That's not saying much because there really aren't many of them. It's simple. It's more streamlined in offering in terms of it's your basic lender, okay? They've got their lending products, traditional banking model, as opposed to the add-on services in wealth management and advisory consulting that you will start to see in some of the other banks. So they are lending out, they're getting net interest margin as their income, and they're also getting fees and that sort of thing. That's how they make their money. What they've done is really lean up their cost structure, get rid of a lot of branches and that sort of thing, okay? They're barely exposed to Russia and Ukraine. So about 1% of their book is exposed to Russia and Ukraine combined. So I don't see that this sentiment needs to be quite so negative. Obviously, I think that they will have some adverse impacts, if not from Russia and Ukrainian conflict, but just the state of the economy in Europe in general is not looking too crash hot. If we take a macro view, interest rates are set to be fairly low for long periods of time. However, eventually there will have to be an increase in interest rates and a return to some positive real rates over time. And that is where I think that I've been wanting to get some exposure to the financial sector. I just haven't been comfortable in what I've been seeing out there. And so this is the way that I see it, one of the few opportunities that I would be interested in playing the space and getting exposure to the banking sector. We do own some insurance, but your traditional net interest margin lending is underrepresented in the portfolio up until now. So an investment thesis, obviously the share price, as I said, have been whacked over 30%, and most of that is basically due to Russia-Ukrainian war sentiment. It isn't really exposed to Eastern Europe, as I mentioned before, and so we're looking to capitalize on a reversion to median trade in terms of the price to book value. That's what I'll be looking at. When it comes to banking, things are a little different. You've got to look at their tangible assets and their book value as opposed to as we would normally look at cash flows and those sorts of things. So we'll be looking at earnings and particularly price to book value. The median over the last almost 10 years has been that the stock is traded at about 0.9 times its book value. Okay, its book value today is roughly around 14 euro and 98 euro cents. So a big discount there. Gaining selected exposure to financial sector outside of insurance, which I mentioned from a portfolio perspective. And we're getting paid nearly 7% in dividends while we wait for this reversion trade to occur. So we're waiting for the market to re-rate the price back to 0.9 times its book value. And there's not a real opportunity cost there in the sense that we are getting paid 7% to wait. So the risks, I've taken some headlines here and just basically copied paste them in and then given a quick synopsis as to why I think it's probably not as bad as some other people think. So when it comes to Russia, okay, so 0.7 billion outstanding will be affected by the new sanctions on specific entities and individuals. So it's a very small amount of their overall gross loan book. In addition, when you look at where that 0.7 billion has been lent, it's to the resources and energy sector inside Russia. So those guys, most of whom have not yet come under sanctions. That's not to say that they won't in the future, but I think that the demand for their business to continue will continue, even if it's just via some alternative methods, shall we say. And so I don't see, from a fundamental perspective, those Russian commodity producers becoming extinct. However, the question will be, can ING legally receive payments on and interest payments on the loans that they've made if Russia is now not part of the SWIFT transaction and information processing system? So I would be looking at this and saying, okay, although I don't think at the moment they're still open for business and they're still able to receive, but I would essentially write that off as part of their loan book just to be safe. And that's another good point, in that when you do write off the entire 1% of the loan book in Ukraine and Russia, does the investment still stand on its own 2 feet? And that's what I'll be looking at in the next few slides. So I don't think it's that bad. 145 billion in cash and investment securities overall versus 0.7 billion exposed to Russia is obviously a very small percentage. There will be flow-on effects, but I think it's contained. In Russia, they're actively managing to limit risks associated with derivative exposure. Now, that does worry me because you never know what you're going to get. Working together with counterparties both onshore and offshore. Now, this is much more complex. I'm not worried about the loan book, but derivatives, depending on how much they've got off the books, that could well be an issue. Now, that's not supposed to happen, but if you read the great book by Roger Lowenstein, When Genius Fails, it talks about the demise of long-term capital management. And in a word, what led to their decline was derivative. Okay, so if they have swap baskets that are not represented on the balance sheet, that could be a hidden risk. 0.9% of the book is in Russian loans. The other 0.1% is in Ukrainian. Okay. As I said, these are the commodity producers who are not yet under sanctions, but we basically have to write it off, in my opinion, as if they were or will become so. Earnings per share. So let's take an earnings summary here. I've used earnings and book value and given historic growth rates. So for both of those, for the book value and for the earnings, I'm only saying, okay, can they grow this at 3% out over the next 10 years on a compounded basis? For my base case, bull case, I've doubled that. And then the bear case, I've actually got them declining in earnings. And the same growth has been used for the book value because they are basically the same for this company historically. Then we look at the multiples, which you can see there. How did I get those? Was basically using the historic multiples because we're looking for a median reversion trade, and then applying a 70% probability to the base case, 20% to the bull, and 10 to the bear. Now, when you look at that, obviously there's huge discrepancy between the earnings valuation and the book valuation. And so what we've done here is we've taken the equally weighted average, suggesting that if we want to get 20% return compounded from our investment, the intrinsic value would be somewhere around $41.73. Applying a 2/3 margin of safety suggests that we're looking to buy the stock at less than $27.50. Let's take the earnings and extrapolate that forwards over the next 10 years using the median multiple as an exit in 2031. And our reinvestment rate is the same as the weighted average cost of capital, which in this case will be our discount rate. So we add up all the earnings, we discount it at the cost of capital, and that's suggesting an IRR in the vicinity of about 18%. So really not too bad at all when you consider we're getting paid dividends as well while we wait, and that we think that we've been fairly conservative in terms of the earnings, and a book value mean reversion would be a huge kick on the upside. If we use the book value method and we use our 0.9 times historic price to book value, discounted at the cost of capital, it's suggesting an IRR of around 40%. So obviously that's a huge upkick. If we take into account the dividend and we say, okay, we don't know what the market is going to be willing to pay, let's just, for reference sake, take another view on the situation. What you'll see here, it says free cash flow, ignore that. This is the dividend, okay? So dividend payment, if it grows at the growth rates you see there in those probability scenarios, and then if we look at the historic yield, the historic high yield, and the historic low yield, and come up with an average. If you discount it at 20%, you want to buy the stock at less than €5. If you use a 10% discount rate, then you can afford to pay up to €9.30, which is well above where the stock is currently trading. So in other words, if you wanted to get a 10% rate of return safely from the dividends alone, okay, so forgetting the equity upside, if you want to get 10% purely from the historic dividend, if you believe that dividend is sustainable, you can afford to pay up to €9.30. So the verdict for me is that I am buying the stock in the eToro portfolio. I will look to make it up to 3% of assets under management. In the arbitrage fund, I am playing it both ways. So I'm shorting puts in the near term out to about 45 days. And I've bought some bull calls and even straight calls out to 2024, 2025, and 2026. That's a great thing about the European options market, is that they are fairly long dated and liquid. And so in terms of how it fits with the formula, you have to make allowance for the fact that it is a bank. So it's not applicable to look at the debt because they take on debt, they borrow short, and then they lend long, which does make it an inherently fragile business model. But I think that the net interest margins will start to work in their favor. They are trading at a margin of safety. If you look at the 10% required rate of return from dividends alone, obviously there's a healthy margin there. There's also a healthy margin in terms of the price to the current book value. Sales growth is there. It's not necessarily the strongest sales growth you'll ever see. It's not a tech stock or anything like that, but it is positive. The margins are positive. free cash flows of banks, that's not applicable. And they do have a history of share buybacks. So with the cash that the company starts to generate, if they were to use some of that to buy back more of their stock, I think they'll start to put a floor underneath the price and make it much more interesting for capital to start to come back into the stock, which will start to bid it up, obviously. As I said, for eToro, I'm looking for about 3% of AUM for ING. Thank you very much for watching. If you haven't already liked and subscribed, I'd appreciate you doing so. If you've got a comment, leave it in the comments section, and I'd love to hear from you. If you're interested in copying the portfolio, all you need to do is download eToro with the link that I'll put in the description and allocate your funds, and away you go. However, if you just want to keep an eye on things, there's also the ability to add the portfolio to a watch list, and therefore you can just keep a track on how things are going. And as always, a very important disclaimer: I am not a financial advisor. I'm not your financial advisor. Everything I do on this channel is me sharing my opinion and what I'm personally doing with my money and the money that I manage. It doesn't necessarily mean that it's appropriate for you, okay? I know that's obvious, but I have to say that. And so please don't mistake anything here for advice. It's what I'm doing and what I think. I could be wrong and it might not be appropriate for you. So by all means, make sure you take responsibility for your decision making, and if need be, go and see a qualified professional in your local jurisdiction. Okay. Having said that, I hope that you did enjoy the video. And as I said, if you have any comments, please leave them in the comments section. I enjoy reading and conversing with the followers on the channel. Thank you for watching, and I'll see you in another video hopefully soon.